Okay, good afternoon, ladies and gentlemen. It's my honor and pleasure to have you all gathered here for our parallel session on financial inclusion. We're very privileged that we have three very nice papers that are quite diverse and talk about different topics. So we start off with Dr. Sadettin Haluk. Sadettin Haluk.
Yeah.
Çitçi.
Çitçi.
Okay, full professor in economics from the Gebsi Technical University. He has served as a visiting professor at the University of Zurich and taught also at the Zabansky University. He holds a bachelor and master from the London School of Economics and Toulouse and a PhD from the Zabansky University, and he has a lot of research paper on economic theory and particularly the influence on psychological and social factors on economic decision making. So we will give you the floor to present the main findings. Of course, this is a co-authored paper, so you have Dr. Halit Yanıkkaya and Dr. Yunis Dede with you. The paper is titled "Do Policy Incentives Foster Wise Financial Choices or Encourage Missteps?" And you have a specific case that you want to shed some light upon. So please, the floor is yours.
Okay, thank you. Thank you very much for introducing me and you come to listen to me. Today I will present preliminary results of our recent paper. So let me start. We don't have much time, I know, so I will start with a quick introduction. We know that retirement saving decisions are one of the most important decisions for financial well-being. And there is vast evidence that in all over the world, both in developing countries and in developed countries, people are generally with suboptimally low level of savings. So one important question is that, one crucial question is about that, what factors influence our saving decisions? Because we know that from a rational decision-making perspective, we are suboptimally low saving compared to what it should be. So we particularly interested in this paper that how our past experiences affect our current saving decisions. This is the first outlet of the paper. And then we also investigated the question whether the saving incentives, again, it is applied in most of the countries in the world, in different kinds of words, sometimes saving incentives, sometimes tax incentives or matching contributions, how they interact with this with the experience effect. Now, so our paper focused on two important questions. The first one is that whether individuals exhibit naive reinforcement learning, whether we weighed too much to our past return experiences in shaping our saving decisions. This is the first question that we are trying to investigate. And the second one is that we check whether there is an interaction between matching contributions policy, that is a kind of saving incentive, with that experience heuristic. So there is only few papers investigating the role of past experiences on financial decisions. The first comes from Malmender and Nagel, and they compared different cohorts of individuals, and they try to understand the long-lasting effects of experience in financial decision-making. And the other papers, Costa, Choi, and Chiang et al., they provided evidence from the same cohort, but very short-term financial decisions and its relation with experiences. In this paper, we first try to understand, our paper differs from the related literature. We again focused on the same cohort of individuals, but we investigated their medium or long-term saving decisions. So we are actually putting the missing link or missing evidence in the literature. We also checked as I said, the interaction between matching contribution and experience effect, but we didn't complete that part yet. So let me give a brief institutional background to understand how the individual pension system works in Turkey. individual pension system in Turkey introduced in 2003, and it is actually a complementary system to the social security system. Everybody can enroll and enroll out from the system anytime they want, and they also decide the amount of contribution paid. So, and there are two important policy reforms in individual pension system. In 2013, the state introduced the matching contribution policy with a huge matching rate, 25% matching rate. Lately, it is also increased to 30%. And in 2017, the government also introduces automatic enrollment system, automatic enrollment policy. In that policy, before the automatic enrollment, people all choose opt-in to the individual pension system. After automatic enrollment policy, people choose opt-out of the system. They automatically enroll to the individual pension system, and they choose whether continue in the system or opt-out. So we use a high-quality individual level data set from Pension Monitoring Center in Turkey. It includes all population. In the data set, we have observations for more than 30 million people, but of course we put important restrictions for our analysis. And in the data, we have annual data for each individual who enrolled to the system at any time till 2021. And in our analysis, we focused for the period 2009 and 2016. So the reason we choose for our analysis period is that we know that in 2017, the automatic enrollment policy is introduced, so it resulted many changes for individual decision saving. So we wanted to exclude that policy change, and we wanted to focus only the matching contribution policy. This is why we ended our analysis period to 2016, and to preserve symmetry, we started the period analysis from 2009. So this equation gives the main estimation strategy. So we basically try to estimate how the past return experiences affected later contribution paid decisions. So we try to estimate the sensitivity of contribution paid of individuals to past return coefficients. So here the CPIT represents the natural logarithm of annual contributions for each individual at any time, at any year. And RIT is the monthly calculated arithmetic average of returns, annual percentage real return. We deflated inflation because in Turkey we have a high level of inflation. So in all the estimations, we deflated that. This RIT-1 is the lagged variable. So it is the previous year's real return, monthly real return. We also controlled for the demographic factors. It includes age, gender, education, and also we controlled for the financial vectors that may influence their decisions. For example, pension companies, their portfolio allocation sets, because it also changed the returns very much, and fund groups. And also we checked the frequent optimizers and the people who has inertia in their financial decisions by the number of portfolio changes in each year. And here, MT represents a binary variable for the effect of matching contribution policy. So we are actually interested in beta 1 and beta 2. They give how contribution paid is sensitive to past returns. Now, this is the summary statistics. So in the end, we have close to 800,000 observations. as you can see that there's almost balanced data for males and females. Most of the individuals are with education undergrads and over. And most of the portfolios include domestic bonds. Now, this is the methodology section. Now, I can continue with the main results of the paper. So, with this estimation methodology, we established that in all of our estimations, both return and lagged return has significance at 1% level. And as you see that, and it doesn't change much with different estimation with different variables, control variables. So what the result shows us is that around 1 unit increase in the previous or in the current year's return increase the year-end 12% increase in the year-end contribution paid. So 1 unit increase in the monthly real return increases more than 10% of contribution paid. The lagged return has also a similar sign and magnitude. So this shows that people are sensitive to past returns, but still we need to exclude some alternative scenarios because, for example, maybe it is rational for them to follow such a strategy. The result shows us for now that they follow a win, stay, lose, shift strategy. I mean, if they have a good return from the previous year or the current year, they increase their contribution paid. Otherwise, they decrease their contribution paid. So still it may be rational for them to follow such a strategy if, for example, they are winning with such strategy. Or there may be some other alternative hypothesis. There are 3 important alternative scenarios that also may explain the results. The first one is that inertia. So the inertia hypothesis basically says that if people just moderately increase their contribution paid from year to year, and if they also have let's say, a positive return in their accounts, so we can observe a correlation between returns and contribution paid. So first we checked for this scenario, and other important scenario is that whether by following such a strategy, win, stay, lose, shift strategy, whether they really has a positive alpha and they persistently increase their investing skills. So if it is the case, if they have a positive alpha, so it is purely rational, not a heuristic. And the third alternative scenario is that some individuals may have non-IPS accounts or assets in addition to the IPS assets. So let's say if there is a positive correlation between non-IPS assets returns and IPS asset returns. So for example, let's say that I have a stock fund in my IPS account and I also have a non-IPS asset as a stock portfolio. If I have a positive return here, possibly I have positive return non-IPS asset too. So now as I have more assets, I may divide some of or shift some of the assets from non-IPS assets to this account. So this also gives the mimic this reinforcement learning behavior. So we also checked this last scenario too. Now, to check whether the inertia can explain our results, we checked the individuals, we categorized individuals to the people who has inertia and people who are frequent optimizers. I mean, this, for example, number 2 represents that people who made change in their portfolio decisions, in their portfolios, at least twice in the current year, in that year. And the individuals, some individuals have more frequent optimizing in their portfolios. But still, as you can see that for frequent optimizer individuals and for the other groups, the results are still significant at 1% level. So the inertia alone cannot explain the results. So we can exclude this hypothesis. So the second important alternative scenario was the portfolio alphas. I didn't include here, but for the whole period, the calculated alphas for individuals was around 0.05. I mean, it is very close to 0. And we checked whether the individual's alpha shows some persistency. I mean, by following this strategy, whether I can persistently have more return than the market. And in all our estimations, our results shows that there is no persistency. Actually, the converse of that, the people generally lose money by following that strategy. But still, they continue to follow win, stay, lose, shift strategy. So this also gives support that this is a bias or heuristic, and experience has an important, significant effect. The last one, the asset rebalancing scenario, we checked, I mean, if this scenario is correct, if people shift from non-IPS assets to IPS assets, when they have a positive return and when there is a correlation, so if this scenario is correct, then we would expect that this sensitivity would increase with age and education, because we know that younger people cannot have many assets, both in the IPS and outside of the IPS, and also more educated people probably have more assets, financial assets, and also they have more knowledge about how they diversify these assets. So if this rebalancing story would be correct, we should see that this sensitivity has a positive interaction or significant interaction both with age and education. However, for both variables, we have non-significant results. So we checked for all alternative hypotheses that came to our minds, and we could exclude all of the alternative scenarios. So far we can say that the only remaining story is the experience effect story. People, our past return experiences significantly impact our current financial decisions, and we put overweight our own experiences. Next question we are trying to examine is the impact of the matching contribution on the experience effect. How the sensitivity change. To be honest, I will talk more about in the limitation slide, but we cannot conclude from our results that matching contribution causally affects the experience effect. But we can see an important interaction with matching policy and the experience effect or reinforcement learning heuristic. Before these 5 columns shows the sensitivity of reinforcement learning or sensitivity of contribution paid to the return variable, and these 5 columns shows the coefficients before the matching contribution policy, and these 5 columns shows the coefficients after the matching policy. And you can see that after the introduction of matching contribution policy, the coefficients changed importantly. Actually, individuals' responses to the returns has risen around 5-fold. So it is an important jump in the coefficients compared to the before policy and after the policy. Let me show how the trend changes after the introduction of matching contribution policy. Before, the coefficients was around that level, and just after the introduction of the matching contribution policy, it increased around fivefold. So this actually, we still need a counterfactual analysis to conclude that matching contribution policy causally impacted the reinforcement learning, but so far we just can speculate about that. So let me finish with limitations. I guess I am just out of the time. So one limitation is that we want to focus on medium-term or long-term savings of the same individuals. So we focused on individuals who stayed in the individual pension system at least 8 years. But in Turkey, the average duration for each individual is around 3 years. So we excluded many individuals. So maybe these results are not, cannot be generalized for all population. So we need to check for people who stayed for shorter periods of time. And also, we need to add a counterfactual analysis to be sure of the causal effect of the matching contribution policy. That's all for me. Thank you for your patience. By the way, I talked some fast. I am aware of that because we had some limited time.
No, thank you very much for your presentation. I think I will start off with some remarks, and then we go for the second paper so that we don't lose the context. First of all, I want to congratulate you on your paper, and actually I'm totally impressed of the system, because we don't have a system here in Egypt. I've never heard about the system in other contexts also. So I think it's a very good initiative. I know you are criticizing it, but I mean it is a good initiative that a government helps people with matching the contribution. Yeah. So I think you should be a bit more fair and not so heavy. I mean, any system can be criticized, yes, but still it is a good idea when a government tells you, we want to help you, you contribute, and we will match your contribution, and it's a free system, and if you want to do it, you can do it. If you don't want to do it, you can do it. And they are keeping, they are still working on it. They are amending it in 2013. They're amending it again in 2017. So it's not like, okay, this is the system and that's it. No, they also understand that there are policies and they respond to them. So I think you should be more happy that the system is there with its limitations. I understand your limitations. What I also don't understand, and I wasn't clear. In your presentation, you're talking about a sample of. I will just go to the questions so that I don't speak, and then I will send you the comments via email. My first question is about the period, because it's mentioned in the paper 2008, 2016, and then in another 2009, 2016, and it's balanced. It's not balanced. And 2013 is like the year where you're not going to take any data. So you should have 3 years before and 3 years after. You have 4 years before and 3 years after.
Actually, we probably wrote it wrongly because it includes 3 years after and 3 years before.
Okay, so it's just a typo.
And also about your first comment, comment is very correct. Actually, our previous paper was supportive, presented the good sides of the policy. In our first paper, we found that matching contribution policy increased contribution paid significantly. And so we established that it has very positive impact for saving decisions. In this paper, we wanted to investigate whether it just cured the symptom, or really it changed also the way we're thinking about our saving. So this was the main motivation of the paper. But in our previous paper, I also presented that paper in ERF. We made it really supported the
Alhamdulillah.
positive results.
The second thing is, and you mentioned here that the people who are, and your sample is 30 million, but you have 782,000 observations. You didn't explain the relation of that to the total. So how did you go about this? Why did you choose these specifics?
The reason is that in Turkey, the duration in the system is very low. Most of the, more than 50% of individuals leave the system in their third year. But we want to check the medium-term effects of reinforcement learning. So we focused on people who stayed at least 6 or 8 years. I didn't remember well now. So, and the number of individuals who stayed in that period was low.
Was this
so
sample?
this is the reason.
Yeah, but maybe you should clarify it a little bit.
This is, I also included in the limitations part.
Yeah.
You are right. It doesn't cover most of the people who stayed in the system, at least for a time.
And going back to the positive, you also here mentioned that there are very positive results. In your part 4, you say there are positive results. But then you are a bit skeptical why they are positive. I mean, again, they are positive. And I mean, you have positive results according to the data.
Do you mean that?
Yes.
So this is actually a question. Okay, I didn't put much weight on this interpretation, but the main motivation of the paper was actually that. So it is a choice of tough love or soft love. By providing such kind of incentives or automatic contribution policy, actually, governments prevent their citizens from, let's say, making wrong financial decisions. But we were asking whether if you show much protection, then they will continue or they will start to make worse decisions.
That's
because
moral hazard, a little bit.
Yeah. I mean, in parenting,
it's not my money. Yeah.
It's not my money, but the problem is that if the governments try to protect their citizens from all their wrong decisions, then the individuals maybe start to make worse decisions. And this positive result, the increase in the coefficients, shows that because reinforcement learning is a bias, it's a heuristic, it is a non-rational way of financial decision making. And the result shows that after introduction of matching contribution policy, this wrong way of financial decision making increased. The sensitivity of reinforcement learning increased around 5 holds. So that is why we interpret as a negative in a negative way.
My very last question is, okay, you have your criticism, and how can we improve it? I mean, the government, from my perspective, I don't live in Turkey, so I don't see, but from reading your paper, is that they're willing to change. So what would you suggest as a change, so to lower this moral hazard, if you can call it like this, or to make people more understanding rather than just doing what they're supposed to do?
By the way, first, so far, I mean, okay, we need to accept that it is not very easy to solve all problems. So we show that it is an important side effect. But still, if you ask personally, I still supportive of this policy. Yeah. I am still supportive of this policy. Overall, as we showed in our previous paper, overall, it increased the total savings. Yeah. But we should be aware of the side effects.
Yeah.
I mean,
what can we do about the side effects? What would you suggest?
I don't want to say just simple the cliche of education, giving more education.
The next paper?
In my, I think that we need to allow people to make more mistakes. For example, in child caring, I am trying to do the same for my son. I am not trying to protect him from everything. I just, okay, make your faults. If it is very important, if it is very dangerous, I try to save you, but otherwise, make your decisions, make your faults, and try to learn from your mistakes.
But here, if the mistakes happen, people are going to come to the government and tell them, You destroyed our pension. You destroyed our retirement money. For the government, this is from the now I'm like wearing the hat of your government. They will not permit this. I mean, you can tell your child fall, and then you will like pick him up. But if we take the money, if I am the government, I take your money and I blow it up, and you lose it, you will come and you will go to the street.
But this is a complementary pension system. Still, we have
but it's still
social security system.
Still, you are. But, I mean, you know that the government is more or less protecting you.
You are right about it. As I told, we are trying to show that there can be important side effects. And in my opinion, this is not a thing that I can show on the paper, or I still examine it. But personally, I think that government should allow to people make more mistakes. And because all over the world there is such a trend. I mean, with nudges or incentives, policies, the government starts to think instead of us. I am not much favor of that. That's all.
Thank you very, very much.
Thank you very much.
We will continue the discussion of the paper at the end, but we will now have paper number 2. Okay. Professor Mustapha Chaffai is assistant professor at the Department of Management and Finance, Business Higher School at Safakis. He's an assistant professor since 2000. He received his PhD in finance and a Master of Finance in Financial Market Valuations from the University of Tunis, a bachelor from the same university. Since 2017, he has held the position of department director. He has participated in many international conferences and seminars and published many papers also on the topic of our paper today. So today he is presenting us the paper on herding, titled, let me read the title, Investor Herding and Islamic Moral Economy and Finance, Evidence in the Islamic Banking Sector of the GCC stock market. So please, the floor is yours.
Thank you. This paper is proposed with Imed Medhioub and Amir Saadaoui, and I am the presenter of the paper. And the idea of this work is to discuss the herding behavior in the Islamic GCC countries, and especially for the Islamic banks and the conventional banks in these countries. And we explore the opportunity that we use data from countries where we have in the same time conventional market and Islamic markets in these countries. First, we have to distinguish between modern finance theory and behavioral finance. If modern finance explain market anomalies, behavioral finance theory consider that investors are irrational and integrates psychology in the investment process. And many psychological effects can have importance in their decision and their choice. And many studies show that behavioral elements play a significant role in determining market prices. The behavior of investor may not be the same according to different situations: sentiment, moral, religious, good, bad news, uncertainty, crisis, and so on. And in this work, we focus on the religious fact regarding the fact and that we have Islamic and conventional banks in these countries. And herding is a process where investors essentially decide to imitate the decision of other investors without considering information on a stock or their own views. And that is what it is. That is not similar to what is done in an efficient market where people don't make decisions regarding the decision of other investors. And this process can lead to distortion in stock and lead to greater volatility when the investor herd in the market, and when we have herding behavior, there is a greater volatility in the market. And herding behavior has attracted research interest during the last decades due to its important implication for market efficiency and portfolio diversification. And the herding behavior is the most studied bias in the research. And herding was tested for developed and developing countries, Muslim and non-Muslim countries. Works on herding introduced the effect of many factors: oil price fluctuation, economic policy uncertainty, investor sentiment, COVID-19 pandemic, etc. And we have introduced the oil price. We have introduced the investor sentiment by introducing the Islamic financial index, and the herding impact the factors related to the principle of Islamic law are not studied. We don't found many research related to herding behavior for the taking in account the principle of Islam. And in this study, we investigate the effect of Islamic moral economy and finance on herding. Why investigate in Islamic stock markets? The rise in global Islamic economy, expected market value is 7.7 trillion by 2025, growth of global Islamic funds by more than 300%, and we can take what said Ibrahim Khan. He considered that Muslim, when they make investment in the market, they are not available and they not have available option for them as Muslim. They stay all time related to the Islamic concepts in their decision. And the Muslim investors generally prefer to invest in Islamic products due to their beliefs and religious obligations. When making decisions in the market, investors consider two principal factors: return and risk. Muslim investors consider three factors: return, risk, and the Sharia principles. We see the difference between non-Muslim and Muslim investors. One take return and risk, and the others take return, risk, and the Sharia guidelines. Herding can be observed in both Islamic and non-conventional and conventional investments. Examine herding behavior in Islamic stock. Understand the Muslim investor dynamic and market stability. The recognition of the herding triggers can help investors in making decisions. Insights into herding can assist policymakers in developing strategies to mitigate risk associated with crisis and the interaction between Islamic and conventional stocks and Islamic moral economy finance. Some works related to herding behavior for Islamic markets. I have already made a study in 2018 with Imed Medhioub, and we studied the impact of conventional markets on Islamic market in the GCC market, and we found that these two markets are correlated, and the Islamic market is impacted by the conventional market. Gabouri in 2022 examined the impact of Islamic events such as Ramadan, Eid al-Fitr, affects social mood, which therefore significantly affects herding behavior in Saudi stock market. Gavrilidis in 2016 concluded that there is significant increased herding during Ramadan in 7 Muslim countries, but few work devoted to the analysis of Islamic concepts on herding behavior. When we observe the Islamic investments are related or take in account alignment of investment with religious leaders, ethical trends driven by shared values and beliefs, but conventional investments take in account trends that influenced especially by media, financial analysts, and market performance. Asset prices driven by collective buying, especially during a crisis. If we see the Islamic investments and the conventional investments, we have the idea for several possibilities. The first is there is no relation between Islamic and conventional, or there is a limited relationship, or an indirect impact due to the distant principle and guidance. There is an interdependence between Islamic and conventional, or there is a global trend, major global events lead to similar herding behaviors. Our question in this research, is there evidence of herding behavior in the GCC Islamic stock markets? Do Islamic moral economy and finance affect herding behavior in the GCC Islamic banks? Does conventional sector affect GCC Islamic stock markets? Is there evidence of asymmetries between down and up market conditions? Because the up and down market conditions can have an effect on herding in the Islamic and conventional markets. Our methodology is based on the cross-sectional absolute deviation that we consider here is the CSID. And in our work, we are trying to estimate first equation 1. And for this equation, if beta 2 is negative, we consider that we have the evidence of herding behavior. The second equation is the equation in which we take into account the CSID for the conventional banks and the squared return for the conventional banks with the return and the market return for and the square of market return for Islamic banks. The third equation is an equation that takes into account the Islamic financial index, and taking into account Islamic financial index is for taking or to consider the impact of Islamic and religious facts in the decision of the investor in the Islamic markets. And after that, we are considering the fact that herding is prevalent during market down turns and upturns. And for this, we take in account the fact that the market return can be negative or positive. And we have in this case two equations, one equation for down and the second for the up market. And our hypothesis, herding behavior exists in the Islamic GCC banking sector. Second hypothesis, Islamic banking sector wide herd around conventional stock market. The third hypothesis is Islamic financial index and oil return have an influence on herding investors' behavior in the Islamic GCC banking sector. The hypothesis 4, evidence of asymmetries between up and down market conditions in the Islamic GCC banking sector. For the empirical analysis, we use data from January 4, 2015 to September 4, 2023. for bank companies in the Gulf countries. And we use Islamic banks and conventional banks. Islamic banks are banks which are 100% compliant with Sharia, and we have the conventional banks that operate in the GCC countries. The descriptive statistics give us the fact that at average, median CSID for both and the conventional banking sector are almost similar. Average Islamic return is higher than conventional banking return, and all series are stationary for both Islamic and conventional banking sector. Hypothesis of normality is rejected, and CSID distribution have a fatter tail. For our analysis, we use two types of regression. We use quantile regression and Garch estimation method. But first, why we use the quantile regression? First, quantile regression models are known to be robust to outlier in the sample, relevant for financial time series analysis, and quantile regression analysis offers larger flexibility than linear regression models, taking into account different market scenarios, lower, upper tails. And extreme outliers are frequently found in financial time series, and many papers devoted to herding behavior analysis use quantile regression, because sometimes herding can be observed at the tail of the series. And the quantile regression take into account the impact of the movement in the tail of the series. We have here the results for equation 1, equation 2, and equation 3. And these equations give us the results that we have an evidence of herding behavior at lower extreme quantile 10%, and anti-herding at upper extreme quantile 90%. The dispenser in the conventional sector impacts Islamic stock market at both lower and upper tails. Islamic financial index negatively affect herding in the Islamic GCC banking sector, and Islamic banking sector wide herd around conventional stock market at upper tail only. If we take the down market and the up market, we have an evidence of herding behavior at lower extreme quantile 10%, and these are the results for equation 4, which take the fact that we take into account that when we have the market return is negative or the market return is positive. And we have here an anti-herding at upper extreme quantile 90% during down market conditions, and we have no evidence of herding during upper market conditions. For the same table, we have Islamic financial index negatively affect herding in the Islamic GCC banking sector at lower quantile 10% only during both down and up market conditions, and dominance of the conventional banking sector around the Islamic banking sector, which is represented here in green. Results confirm the evidence of asymmetries between down and up market conditions. We use the DCC Garch method, and this method allows us to take into account the correlative matrix to dependent on time, and DCC Garch allows to take into account the dynamics of the volatility and the correlation between two or more variables. DCC Garch has a substantial effect in describing the dynamic mechanism between financial variables. Study the co-movement between CSID and the Islamic Financial Index, oil, for conventional CSID. We measure the interaction effect of these phenomena in the Islamic GCC banking sector. And we analyze the influence between Islamic financial index and oil and herding in the Islamic GCC banking sector. DCC gauge is used to measure the interaction effect of these two phenomena, and we built a DCC gauge model to examine the dynamic correlation between Islamic financial index and oil and the CSID variable. The results. For our model, we have first to verify if the alpha and beta is lower than 1. And we have a DCC model is correct and well specified because the sum between alpha and beta is lower than 1. We have significant estimated coefficient alpha, and we have the presence of dynamic conditional correlation in the short term between Islamic financial index and herding. We have a significant estimated coefficient beta, and we have the presence of a dynamic conditional correlation in the long term between Islamic financial index and herding. These are the estimation between CSID and the Islamic financial index. And we can say here that the Islamic financial index influences CSID and therefore influences herding on the Islamic GCC banking sector. These conditions are verified when we consider CSID and oil return, and the sum and the beta equals to 1. The dynamic conditional correlation between oil return and herding persists for long time. And we can say here that oil return influences CSID and therefore influences herding on the Islamic GCC banking sector. If we take into account CSID and conventional CSID, when I say CSID, that is the CSID for the Islamic banks, and conventional CSID is the CSID for conventional banks. We conclude that conventional dispersion influences CSID and therefore influences herding on the Islamic GCC banking sector. To conclude, we can say that our results suggest the evidence of herding behavior in the Islamic stock market and Islamic stock market wide herd around conventional stock market, suggesting then their interdependencies as both sectors operate and interact. Dispersion in the conventional sector impacts Islamic sector, and the results confirm the existence of asymmetry between down and up market periods. Herding is more significant at lower tail when market is falling. These results are in line with the previous works, for which herding behavior is more pronounced during extreme down periods, more than extreme up periods. As a limitation for the work and as a proposition for future works, we can say that we have the possibility, for example, to integrate the impact of uncertainty and geopolitical news on herding behavior in the Islamic stock market. Thank you.
Thank you. Again, I want to be very quick because we still have a paper and we have to open the floor for the discussion. I want to thank you. First of all, I want to thank you very much for your paper and your presentation. I have some comments related to the format of the paper, because it's not very clear. In the tables, you put A and B and C, but we don't know the significance, so you should add what A and B and C stands for. But I have more concerning questions, and I'm going to, like in the previous paper, ask you the questions, and then you can answer. You can answer me according to the way. the whole idea about herding, I do understand that you see herding as a very negative thing. And I actually don't share this because, I mean, if now the bell rings and there is a fire alarm and you rush, we as herding, what will we do? We will rush. If we start to do our own decision, we will not rush out. And I mean herding, and you also say it's more of a panic. And people are doing it out of panic because it happens when there is a downturn. Okay, so what do we do, for example, in the Egyptian stock market? And I guess they do it also in other markets. We have holds. We have a stock market hold. So 30 minutes, there is no trading. When we feel that the market is overly doing a herding behavior, we have tools to stop it. So my first question is, why do you only see it as an irrational behavior? Because herding can be rational, and herding does not have to be irrational all the time. Okay, and secondly, what are the propositions that we can make in order to make, when there is a panic in the market, when there is a downfall, how can we stop people from doing the irrational herding? That's number 2. Number 3, I think I think it's a bit unfair to compare US and China with the Gulf countries, even if it's now very big. But still, we're talking here about a very, very small stock market. And you didn't even talk about the stock market. You chose to talk about the banking sector. I read your paper in 2018. It was much more comprehensive. And you're talking about the different sectors. And you reached different results for different sectors. So you said in the food and beverage is different. Here you're focusing on the banking sector. And you're like generalizing the results. I don't think it is fair to generalize these results, and I think this is a limitation of the paper that you should really admit to, that we are talking here about a very small tranche of a very small market. If we're talking about Islamic finance, where is Indonesia, where is Malaysia, where is Egypt? I mean, these also have Tunisia, where there are, I don't think we can be very fair to say this is the example that we have for Islamic banking, and look, in China and in the US, they don't have herding, they are developed, they do it the right way. I don't think that this is well, I mean, I will let you answer the last 2 comments, and then you can answer them all. Is again the idea about Islamic finance and non-Islamic finance, because we have this issue here in Egypt also. I mean, your results show that there is no significant difference, okay? So, I mean, isn't it just a label to attract some of the people who have issues with it, or it's not really different? And I mean, they're not doing anything different. They're calling it different, but there are interest rates, I mean, so don't you think it's just a label rather than a really big thing, Sharia and riba and anti-riba and whatever? Or isn't it just a label? Even your final results, what is the main difference? And my very, very last comment, and then of course you can, why also do you look at the stock market as a whole? I mean, also in the Gulf, there must be foreigners, there must be domestic, there must be institutions, there must be individuals. But again, do you have any understanding of, is there differences, or what is your suggestion? And then your final recommendations. What would you recommend in this context? What should we do as an emerging market in Egypt, for example, also? Thank you.
Okay, thank you. First, for the question related to the fact to taking into account Sharia and distinguish between Muslim and non-Muslim countries. The problem, you are Muslim or not Muslim, you are a person and you are affected by your psychology and you are emotional individual.
Yeah.
And that is sometimes a supposition that we suppose that when we invest in Islamic stocks,
You're doing something good.
yes,
Like green bonds.
yes, but we are a person, and everyone can be affected by many factors, and which are not factors related to the market.
Yeah.
Individual
You
factors.
also mentioned Ramadan, and then we do the same on Christmas.
Yes,
But it's
yes,
again not religious.
yes, yes.
I think it's not because we believe in Ramadan or we believe in Christmas. It's just that it's a holiday, it's a long time.
Because the Muslims speak about Ramadan effect, like what people in the European countries, they speak about the January effect.
Yeah.
Yes, but it's the same thing. But we have make a research, and people try to find something similar what arrives in the European or American countries. They said we have the Ramadan effect, and in fact, Ramadan that is not this month who affect the results on the market, and that is not Ramadan who affect the index. That is what people do. We are not taking in consideration what happens in the market. People try to take in account the religious facts, to pray, to have activities different about their activity in other months. And that is why we have the Ramadan effect. But that is not Ramadan, the fact of this phenomenon. The second point, considering the A, B, and C, that is for the level of significance, 1%, yes. 5% and 10%. It's not, yes, yes.
Stars,
yeah.
It's clear, 1 star, 2 stars, 3 stars.
Well. The other question?
The size and the focus on the banking sector.
The banking sector. We have an earlier study which in which we have the segmentation between industrial, commercial, services, and banking sector, and we have conclude that the banking sector is the sector which is have the more importance in the GCC countries, and then we have take only the banking sector to study this sector.
Thank you.
Okay, thank you.
Now we have our final paper. Then we will. Our final paper, Dr. Wafa. Dr. Wafa Khémiri is Assistant Professor in Finance, Faculty of Legal, Economic and Management Sciences at the Medhioub University, and she has obtained her PhD from the University of Manouba, Tunisia, and she has published many academic works in international refereed journals, including the Quarterly Review of Economic and Finance. The paper is titled, Does High Liquidity Creation Reduce the Efficiency of GCC Islamic Banks? And the floor is hers.
I'm pleased to present my paper titled, Does High Liquidity Creation Reduce the Efficiency of GCC Islamic Banks? The Role of Sustainable and Governance Factors. The outline of this presentation is structured as follows. First, I discuss the motivation for this study, followed by literature review and hypothesis development. Next, I present the methodology adopted in this study. The results will be discussed later. This study concludes with several implications. Today, Islamic finance is growing rapidly in the GCC countries. Based on late statistics in 2024, Islamic banking assets are expected to exceed $180 billion The prohibition of interest rates in Islamic banks limits the use of traditional debt, which creates money in conventional banking system. By using PLS contrast, credit generations becomes more prudent based on real investment and rigorous risk assessment. This characteristic can lead to over-liquidity creation, which in turn can compromise efficiency. However, despite these challenges, despite these challenges, certain factors such as corporate social responsibility, audit quality, Sharia supervisory boards, and institutional quality can help mitigate over liquidity risks. In this context, this research has two goals. First, investigate the nonlinear relationship between liquidity creation and Islamic bank efficiency. Next, examine the moderating effect of sustainable and governance factors on this relationship. In theory, the relationship between liquidity and efficiency can be explained by two main opposing hypotheses, namely liquidity creation stability hypothesis and the liquidity creation fragility hypothesis. Based on liquidity creation stability hypothesis, liquidity improves efficiency by increasing depositor confidence and attracting more investors. However, according to liquidity creation fragility hypothesis, excessive liquidity can weaken efficiency by encouraging massive lending, leading to higher risks. In practice, previous studies examined the relationship between liquidity creation and bank stability, showing mixed results. In addition, other studies investigated the direct effect of CSR and governance practices on efficiency and Islamic bank stability. However, the literature in this area ignored to examine the non-linear relationship between Islamic bank efficiency and to evaluate the moderating effect of sustainable and governance factors on this nexus. In this context, this study aims to fill this gap by providing new insights into these dynamics. This slide summarizes the 5 hypotheses tested in this study. So to test this hypothesis, I adopt a panel data econometric approach using a sample of 43 commercial banks from 5 GCC countries over the period 2012-2020. The base models are formulated as follows. Where IB is Islamic bank efficiency is a dependent variable, LC liquidity creation is a main independent variable, the term square donc liquidity creation, CSR corporate social responsibility, AQ audit quality, Sharia supervisory board SSB, and IQ institutional quality are moderator variables. This slide summarizes the definition of all variables. In fact, to measure Islamic bank efficiency, I follow Li et al. 2023 and Fonseca et Farouk 2024. To do so, I use 2 inputs and 2 outputs. To estimate DA approach, I use deep software. In addition, to measure liquidity creation, I follow Berger et al. 2019 using the following ratio. This slide summarizes the measurement of moderator variables. Finally, I also introduced a number of control variables into my model, including assets quality, size, cost, inflation, and GDP growth. Let's now move on the discussion of the results. The main results show the presence of non-linear relationship here between liquidity and efficiency. This relationship takes the form of inverted U-shaped, confirming hypothesis 1. This result means that the relationship between liquidity and Islamic bank efficiency changes from positive to negative. More specifically, there is here an optimal level of liquidity equal to 31.6%, below which if liquidity increases efficiency. However, above this level, excessive or massive liquidity reduces Islamic bank efficiency. In addition, the results indicate that CSR, audit quality, SSB, and institutional quality moderate the nexus between liquidity and Islamic bank efficiency. Finally, to improve Islamic bank efficiency, policymakers should optimize liquidity management to reduce costs, regularly monitor and adjust liquidity level, strengthen commitment to CSR activities, and improve governance practices. Thank you for your attention.
Thank you very much for your paper and for choosing this topic. Again, here I have some few questions. Again, I am very concerned about your sample because I think your sample is very biased because you're just talking about the Islamic banks. So we don't know the non-Islamic banks, how do they deal with liquidity? I mean, liquidity is a problem for all the banks. So here you have, I think you should maybe in your next paper focus more on telling us if this 31% is a valid benchmark in all conventional and Islamic banks or not, because this is a little bit of a bias. My other question is about what are we going to do with this result? I mean, what is your suggestion that you will suggest to enforce a benchmark of liquidity on banks, to improve it in terms of putting a limit? Banks cannot hold more than this.
Yes, or to introduce other variable to investigate on activity CSR, for example, to improve audit quality. Or governance. That's it, generally.
You mentioned in your paper that you think that banks issue risky loans to generate liquidity. Do you think?
Can you repeat?
You said on page 5 in your paper, banks issue risky loans to generate liquidity. I don't understand what you mean by that. Why would they do that? I mean,
maybe.
And when they generate loans, they're not generating liquidity. Isn't liquidity the opposite when they get the deposits?
No, it's not. It's not.
She's not picking the question.
You're saying here in your paper,
yes,
in page 5, that when the banks, you have a problem with the liquidity.
Yes.
And you say banks do issue risky loans to generate liquidity.
When the liquidity is very high, massive level of liquidity, we can talk about risk,
Yeah.
The Islamic bank can have a problem
of high level of
liquidity.
Yes. But again, I don't understand why would a bank that has a problem with liquidity issue loans?
To generate income.
That's it.
Under liquidity.
You can see here, I don't know, the curve. Oops. Wait. Here the curve takes the form of inverted U-shaped.
Yeah.
It represents a risk.
Yeah.
Manager, so I don't know.
Yeah, but I
in
mean,
French,
for me, it's logical. Okay,
it's like logical.
Yeah, you have. Yani the bank has liquidity.
Yes.
Okay, this is what it needs, or else it will be at risk that when the customers come, that they don't have cash, and then there will be a crisis.
That's it.
But they cannot have too much liquidity, because this means that the bank is foregoing opportunities, because this is idle money. It's money that is not generating interest or not generating. So it's the opposite of loans. I mean, if they give out the liquidity in loans, then this is then they're generating money. So loans cannot be affecting liquidity negatively. They can only be positive.
Okay.
Okay. I mean,
Okay,
if I have liquidity, this means that you go to the bank, open the vault, they have liquidity, they have cash. But if they take the money and give it to the investor, it's not liquidity. It's the opposite. It's generating income. Okay.
Okay. Thank you.
Thank you very much.
Thank you.
Okay. Thank you very much. I know we're very tight on time, but we had to start a bit late. So I want to open the floor for all the attendees to, if they want to ask, we have here our 3 distinguished speakers, if you want to ask them any question or have a comment on their papers. Anybody from the floor? I have to give you the mic because they're recording.
Thank you. So I think this is in relation to the first paper. Thank you very much for this nice presentation and great paper. So I have a few points. So firstly, I think I would want the paper situated more in kind of the opportunity insights literature, the Rashati papers on subsidies to retirement saving, essentially, which is similar. So I think these papers look at Denmark, and I think a good contrast is what is happening in Turkey. I think the second thing that I wanted to understand better is how exactly the policy was administered. So is it that it's 25% and there's a peak, or if you pay $1 million in, then you'll get a...
There's a threshold.
There is a threshold, okay.
I didn't mention in this paper.
Right.
Actually, in the previous paper that I mentioned, we checked how significantly affect the policy, the total contribution paid. And in order to use a regression discontinuity analysis, we used that threshold. So it was around annual gross minimum wage. The threshold was that kind of amount.
And so it gives you a natural control group, even in this analysis. So in this analysis, you can...
In this paper, we didn't use it that. I mean, we plan to use that. We plan to use that. We first checked for the sample for the people who stayed in the system for 8 years. For them, above the threshold, almost there is none of individuals. So we need to shorten the period. So we need more individuals above the threshold. So this is this is a nice comment.
Okay, and then but you can't use it basically for this point.
Still we didn't use, but we plan to use with another with more sample.
Because I guess part of this is that, I mean, you're honest in saying that I don't know if this is causal. We're kind of hoping that it is causal or wishing. But then suppose we believe the result, which I think is similar to the comments by the doctor in her discussion. I think the question is kind of how do we think of welfare here? So obviously the government is trying to incentivize retirement saving for a specific purpose that people are not without money in end of life. But that's kind of encouraging to some extent an adverse behavior, which is this kind of irrational. This is taking your result at face value. It could be, for example, that there is an optimal point between the 0 and the 25% mark that the government could choose to balance these two objectives, that they want them to save more, but they don't want them to be excessively misstepping or making mistakes in their financial decisions, such that, so kind of how do we think of welfare from the government's perspective is another question.
It is actually, for this paper, when we were starting, our objective was just to check the existence of reinforcement learning. But then when we working before after analysis, we again just to be sure that there wasn't any bias concluded by the policy. And when we were checking the before the period of the policy, we noticed that there's a huge difference. And we try to understand the reason. And we understood that there's actually some mechanisms that the policy may intensify that reinforcement learning. So we're still about thinking about the causality problem. This is the first. And the second one, what should be done if it is the case. For the second problem, for the first problem, as I told, we plan to use the threshold and use a regression discontinuity research design estimation. For the second question, actually, it is more important than the welfare. We wanted, there is, in the literature, there is no paper showing the side or negative effects of nudges or that kind of incentives. There is other side of the flip coin. There is a nice paper of John List. I don't remember the year of the publication. He showed that when people get more experience in the market, they make less mistakes. They start to behave more rationally. But with that kind of nudges and incentives, we always protect individuals from the making mistakes. So actually, maybe we let them to make longer-term mistakes. So for me, I mean, my objective for this paper, after controlling causality, and I am not sure that after controlling causality whether this result will survive, but if it is so, if it is survive, then it is enough for me to show that we should be careful. There are some side effects of controlling people. But you are, again, I mean, from the policy perspective, but from policy perspective, you are right. I mean, there should be cost and benefits. But for now, I am not looking from the policy
From that perspective of the policy. Okay.
Yeah.
You have a question?
No, you want to continue?
One last question, if you don't mind. So you mentioned the withdrawal, so people can withdraw at any point. Is there a cost to withdrawal, or is it like a...
There's almost no costs. And opt-in or opt-out, there is almost costless. I mean, costless.
So, but then, yeah, the sample selection becomes a serious concern, right? That you might be selecting people who are kind of not adapting and not adapting in their decision-making, so they're more myopic, if you like.
Yeah, it may be. Okay.
Thank you. Sorry, go ahead.
No, that's okay. We benefit from your interventions. Thank you very much. I just want to give a sort of a generic comment, and I would like to commend their efforts. I think the two topics are very much relevant, particularly when you look at Islamic finance, and I do agree with you, Professor. It's always good to have this comparative analysis between the Islamic financing and the conventional modes of finance. And I also pretty agree. I started my career as a microfinance officer, and I remember when these Islamic modes of finance were introduced, and a lot of debates in Sudan, which is also an Islamic country and an Islamic Arab country. But eventually, when you come close to the way we do business, it's a little bit of labeling things in a different way. And I remember the thing is, if you want to give somebody a murabaha, let's say, so murabaha is simply, and instead of giving the person the money, he or she, and that person goes and buy the business items, so you take that person to the market and you buy, and then you say, well, look, what I've sold for this person is the items and not the money. So in order to avoid the usury, the riba, and this kind of things. But I think Islamic finance is becoming momentarily a topical issue. I work for the United Nations for now. There is a lot of also debate around also, because when you operate in a certain context also, sometimes you need to look at the implication of things. Particularly, sometimes you work in areas where you want to affect changes in the community in order to achieve development gains. So penetration of the culture itself is need a delicate way of handling things. And I think the labeling of Islamic mode of finance is a good one in order to ensure financial inclusion. The saving aspect, I'm happy that I attended your paper, and I'm happy also you highlighted the importance of saving in the literature. It's interesting because I witnessed the war in Khartoum, and the herding behavior also, I tend to agree with you, is something, I don't know, but you know, when the war erupted in Khartoum, I was there as a head of an agency, UN agency. Most of the people, they just fled. What I did, which I did not follow the herding behavior, not because I'm so wise enough and rational, no, because I had to do some other jobs. But you know, the saving aspect after the shock, before the war, I myself, I was impulsively spending my money in luxury. But after the shocks of the war, most of us, I'm not only myself as an individual, but a lot of people, they start thinking wisely of, you know what I'm saying? Maybe I need to put this amount of money because of this and because of that. So I think the topic of saving itself is one of the topics also I think we need to look at critically. When you take it at I'm taking time also, you see? Sorry for that also. When we look at it at the level of the low-income people, that's also an important area for exploring it and see. Because, you know, in Sudan, for instance, and it looks like the same Ramadan, you know what I'm saying, and the Christmas, you know what I'm saying? So a poor family, they do their own savings, and they keep running until the time where Ramadan and Eid will come, and then they go and they consume all the savings in bed sheets and many things that might not survive the income of the family after the event in itself. So I think these areas of the behavior of the people, particularly the low-level income people, this is a very interesting area to explore in saving. Thank you.
Actually, a comment related to your last comment. Now in Turkey, it is as a new policy is planning to be implemented, and it is following that. I mean, related with your comment. Now they are planning to not allow people to withdraw their money easily whenever they want. They will try to put a third pillar to the system. So we have already a social security system and individual pension system. Now a third pillar will be, let me say, another individual pension system that you must have. And you cannot withdraw your money from that till some periods of time. But it is not started to implement it now, but I am almost sure that it will be started to implement it. And it's correct that sometimes just some event triggers you and you start to spend all your savings. Yeah.
Thank you so much for the very interesting and wonderful presentations. I just have a couple of comments for the second and one comment for the third, but I'll be very quick. The second presentation about herding behavior in Islamic and conventional banking. Herding is, simply speaking, there's investors mimic the decision made by other investors during a crisis or troubling period. And you justified your research question and paper based on the idea that is people during this time would like to diversify their portfolio, taking into account religious background. But this comes back not about herding, it comes back about portfolio diversification under a troubling period. The second point you raised is about anomalies and day of the week effects. It has nothing to do with herding. So I believe that is you do need to provide theoretical justification for your research question. What is unique about Muslim that make them take decision that is completely different from conventional? Otherwise, for me, it's simply speaking, they are both. It has nothing to do with the religious at all. So this point has to be made clear just in order to be able to motivate the paper itself. The second point I just want to raise, that is, you already highlighted the issue of financial leverage and pull and peer markets. But when it comes to the second part of the paper, talking about the dynamic conditional correlation, you use the DCC Garch model, which actually doesn't account for financial leverage. A better choice will be the asymmetric ADDC Garch model, which can take this issue into consideration and will be consistent also with your first part of the paper. One point about the final paper, thank you so much for the wonderful presentation. I'm just wondering what panel data model you already used in your analysis, because simply speaking, there is an issue of reverse causality, because if the bank is actually more efficient, they will be able to attract more money, leading to high liquidity creation as well. So there is a reverse causality. And if you didn't take into this issue into consideration, all these results will be biased actually. So I'm just wondering what type of model you already used. Thank you so much.
Thank you.
So, I use GMM system GMM to resolve endogeneity problem. Okay. Question.
That's about reverse causality.
No, I'm not.
Because we introduce the moderating effect on the
In the model, examine the moderating effect.
Because the model is in two steps. First step, the impact and the non-linear impact on liquidity creation and Islamic bank services. The second step is to introduce. The second step is to introduce the money factors, sustainable and governance factors. In this case. Especially the system GMM is the best here. Yes.
I think we have to stop here, but we can continue.
Bilaterally, exactly.
Thank you very much.